Just as we were getting to grips with the fallout from the demise of Silicon Valley Bank, another potentially far more significant bank fell into crisis: Credit Suisse. Now, there's little good reason why one should lead to the other, and yet it did. You see, SVB made investors worried about banking stocks in general, and they plummeted around the world. In the 3 days after the run on the Californian bank, the stocks of US financial institutions fell by 9.4%, and European banking stocks tumbled 11%. Then two things happened that massively worsened the situation at Credit Suisse. The Zurich-based lender was already in trouble after years of scandals and mismanagement. Then, on March the 14th, not 4 days after the SVB affair, the Swiss bank announced that US regulators had found problems with its financial reporting and control procedures. The timing could scarcely have been worse. The sucker punch was an interview with the bank's biggest shareholder, Saudi National Bank, a day later. Chairman Ammar al-Qudairy was asked if he'd be willing to invest further in Credit Suisse if it needed the money.
The answer is absolutely not.
That threw fuel on the fire. The stock fell off a cliff. The Swiss central bank tried to provide reassurance that Credit Suisse wouldn't run out of money by providing access to further capital, but that wasn't enough. After a hectic weekend of talks, an agreement was reached for crosstown arch-rival UBS to acquire Credit Suisse for about $3 billion. Just 5 years ago, Credit Suisse was valued at $50 billion.